All right, we're going to do 2 complete days on Chapter 21. So today I'm going to be focusing on the indirect method of completing the statement of cash flows. So today is all going to be about the indirect, and then on Tuesday I will focus on the direct method. All right? So, and the only difference between the two, the only difference between direct and indirect is the first section. This cash flows from operating activities and the way that you calculate that. And so the statement, the section for cash flows from investing activities and from financing activities are the same under both approaches. So the first 2 exercises I'm going to do are just that first section. So let's start with exercise 21-6 on page 21-56. So on this one, it just gives you a listing of various financial information that were pulled out of Hyde Company's records for 2013. So it's going to be Hyde Company. The statement of cash flows. For the year ending December 31st. So as standard, this is just like the statement of the income statement and the statement of retained earnings. This is measuring activity. The balance sheet is the only one that does not measure activity and is only dated the date of the financial statement. So we're going to focus on operating activities. The difference between the indirect method, which overwhelmingly is what U.S. companies publish, it's well over 70-80% of the United States companies issue indirect statement of cash flows. The international community does not allow the indirect method, so the United States is the only place that you use the indirect method now, but it is the most popular way. And the main difference between the two is indirect starts with net income. Which your book in your problem has 10,800. To that, we make various adjustments. For non-cash, and non-operating. Items. Non-cash are items that affect net income but did not involve any outlays of cash. And there's a number of them in this category. Depreciation expense is the most common. Almost all companies are depreciating some sort of long-term property, plant, and equipment. Some companies will also have intangible assets that they're amortizing. They may have natural resources that they're depleting. All right? All of those are non-cash in nature because you outlaid the cash as an investing activities when you bought those long-term assets. All right? So any type of those three, depreciation, amortization, or depletion, are adds. You also could have a series of ones that you have to subtract. Examples here are gains on the sale of non-operating assets. So if you sold a truck during the year, or you sold a plot of land, you would, at that point, subtract it from net income if you had a gain on that sale. All right? That's non-operating in nature. It's not in your core business to buy and sell property, plant, and equipment. All right? So in this list, we have some depreciation expense. It's item number C for $7,400. And that's an add back. They also, item number L, have some patent amortization. For $1,000. And that's it for non-cash expenses on the income statement in this particular problem. They do, however, have a non-operating gain on sale of land, item H. So we need to subtract that gain because the gain increased net income, but it's not operating in nature. $8,000. And the last of these adjustments for non-cash, non-operating, this is a non-cash item, but it can either be an add or subtract depending upon. And that's A. A in this problem says amortization of premium on bonds payable, $600. Now think this through. If you issue a bond at a premium, what happened with the market versus your cash face interest rate? The market was lower. You're paying more. So what the amortization of the bond did was take the amount of cash that you spent and lowered the interest expense. All right? Well, it lowered it without having to spend any cash because you got the cash up front when you received the bond. And issuing bonds is a financing activity, not an operating activity. So this is artificially lowering the interest expense, which interest expense lowers premium amortization. Yep. Interest expense lowers net income. Let me think this through. I'm backwards. Because this is a subtraction. Bond premium lowers, yes. So what it did was it artificially lowered the interest expense. So we now need to take that out by reducing net income. Does that make sense? If it doesn't, let me know. Think it through. It's $600. For simplicity's sake, let's assume the journal entry was interest expense $1,600, right? And then we amortized $600, and then we paid cash of $2,200, right? The actual cash outlay was $2,200. So this is artificially driving down, well, not artificially, through the sale of the bond at a premium, it is reducing interest expense from where it would have been if we were just paying cash. Right? If we had sold the bond at its face value, we would have had a $2,200 interest expense for the year. So what we're doing, that is increasing our profit because interest expense is lower than it would have been. So we're reducing the net income by the $600 amortization.
So whenever it's a premium, we reduce it, and whenever
it's a discount, we're going to add it. But think through the logic as to why you're doing it, because there's a later example where we've got a bond that we bought at a premium or a discount, and that's going to flip-flop it because that is artificially increasing or lowering interest revenue at that point, not interest expense. So think through the logic of it, so no matter what you get presented with, you can handle the entry. Okay? All right, so that's the end of the adjustments for non-cash, non-operating. We then make a series of adjustments for cash flow effects from working capital. Items. So what's working capital? Somebody knows. Somebody remembers. What's working capital? How do you calculate working capital? Do you remember that from the very last chapter of Principles of Accounting 1? Or no? Not a prayer. Okay. Working capital is current assets minus current liabilities. Okay? So current assets minus current liabilities is the definition of working capital. All right? Whether it's positive or negative. So changes in current assets and current liabilities are reflected in operating activities. And you'll see when we get through the entire 3 sections of this statement, you're going to use the net changes from the beginning of the year to the end of the year for every line on the balance sheet. Okay? You're going to use all of it, as well as items off of the income statement. So the first one we have in here is we'll start with accounts receivable, item number D. Accounts receivable decreased. So if your accounts receivable went down by $800, what happened to your cash balance? It went up. Current assets have an inverse relationship to cash. Because if the accounts receivable balance went down, your customers were paying you. They were sending you cash. If it went up, conversely, they're not paying you, and you would subtract it from cash. The only other, well, there's the second item is inventories, item G. Inventories went up $7,500, an increase. So that lowers cash because you're buying more inventory. The only way to buy more inventory is with accounts payable and spending cash. So if you're investing in more inventory, your cash balance goes down. And then the last thing we had was an increase in prepaid assets. This is prepaid insurance, prepaid rent, things like that. It also went up, which means you're buying more of it, and that's $500. Current liabilities, accounts payable went down. We had a decrease. In accounts payable. $2,800. So if your accounts payable goes down, what does that do to cash? It decreases it. There is a direct relationship between current liabilities and cash. If your accounts payable went down, you sent money to your vendors, everyone that sends you invoices. And then lastly, we had an increase in wages payable. $300. If you add up all of these adjusting items, you will get 9,900 negative, leaving you with $900 as net cash provided by operating activities. Because it's positive. It was cash provided. If it was negative, it would be cash used. All right? So this word here will change depending upon whether the section that we're calculating of the three sections is a positive number or a negative number. If it's negative, it's net cash used by operating activities in this case. All right? Does this make sense? We're going to do another one.
I have a question.
Yes.
So what about the issuance of long-term note cash?
That is a financing activity. So it doesn't, they gave extra information in the problem that doesn't apply. Yeah. Yeah, the only thing that is affected for operating activities are off of the income statement, non-cash expenses or non-operating items like gains. Okay? All right. let's do the next one, which is a little bit more complex. It's problem number 2 on page 62. Starts on page 62 and goes to 63. I might be able to fit all that in. Nah, no way. So because of the complexity of this one, I'll probably start it in this column and then work over there to finish it up to get it all on one board. So this is the same kind of approach. They're just giving you a list, now A through R, of various items that will affect operating activities. And on this one, they do not give you any extraneous items. On this one, well, no, I take it back. Item O, they've got proceeds from the issuance of stock. That's a financing activity. That's not going to affect operating activity. But everything else, everything else we'll use. Oh no, in payment J, they've got payment of cash dividends. That's also not a operating activity. So net income for this company is going to be $68,400. All right, let's just take them in order. Item A is accounts payable. That's going to be working capital. That'll be the next section of adjustments. Item B is a loss on the sale of land. So if you lose money by selling a piece of land that's non-operating in nature, you need to add that back. So loss on sale of land. $1,900. C and D, an increase in inventory and an increase in income taxes payable are both working capital. Item E is net income. We've already used that. Item F, patent amortization expense. Patent amortization expense was $1,600. A non-cash expense. Item G, we had an extraordinary loss. So if we have an extraordinary loss, that is lowered net income, we need to add it back. $6,200. A decrease in deferred taxes payable. Now, deferred taxes payable is technically a working capital item. However, it is also non-cash in nature. All right, because deferred taxes, as we learned from the chapter a few chapters ago when we were talking about accounting for income taxes is a calculation of taxes, income taxes payable, and then make adjustments for deferred assets and deferred liabilities in order to come up with the income tax expense. But they're non-cash in nature. These are things like accelerated depreciation for tax purposes over what you took for U.S. GAAP financial purposes. So a decrease in deferred taxes payable is increasing our income tax expense. So if decreasing our income tax expense. So if it's decreasing it, we need to subtract it. It's a deduction. So a decrease in deferred taxes payable. Can't even write. And it says here $2,500. And in yesterday's class, I see there's only one of you. In yesterday's class, we had 3 people taking notes in Excel on their laptops. And my answer key says 1,400. It's got the wrong name on it, the wrong number on it. So we got to the end, and I wrote up the total for cash provided from operating activities, and it was off by $1,100 because they kept adding it. People pulled out calculators and added it, and I went, no, here, I got the numbers all right. Well, my answer key is wrong. And so they were betting me yesterday as to whether or not any of you would notice. And I said, no, first of all, they're a smart group. I mean, they got the 10:30 class, and they're going to notice. And they said, and I said, plus I'm not going to torture them. So it's 2,500. That's what's in the book. But I guarantee you, it was a 15-minute diversion while we went track through that mistake because it couldn't make any sense because it never occurred to me. And the really funny part is that this is the 4th time I've taught this class. And in every section, I've always had somebody taking notes on Excel, and nobody ever mentioned it, that it was wrong. Anyway, that's why we didn't cover as much yesterday as we're going to cover today, because it was driving me crazy. I mean, how in the world can it be off by $1,100? So, anyway, we found it. Just took a little while. Okay, here's an amortization of discount on bonds payable. So this is just like the last problem. We have an amortization of discount on bonds payable of $1,300. Item J is the payment of cash dividends. That doesn't even belong in this section. Item K, depletion expense. So like I mentioned, depreciation, amortization, and depletion are all non-cash. $5,000. Then the next 2 are working capital, salaries payable, and accounts receivable. Item N is a gain on sale of equipment. So if you have a gain that increases net income, And so we need to back it out, 6,100, and reduce the cash. Item O is not applicable, proceeds from issuance of stock. And now we've got an extraordinary gain. We had an extraordinary loss earlier, now we have an extraordinary gain. $3,700. Almost done. Depreciation expense. $10,000. And then the last item, this is a good one, amortization of discount on investment in bonds. So this is a discount, but this is the opposite. This is a bond that we purchased, not a bond that we issued. So if we got a discount, that means that the bond was paying less than we, as an investor, wanted in order to make an investment of similar risk. So this is artificially increasing our interest revenue, thus artificially increasing net income. So this one is, so we need to subtract this. So amortization of discount on investment in bonds. And that one was 1,500. God bless you. All right, so that's it for the non-cash, non-operating. So then we're going to make a series of adjustments. For cash flow effects from working capital. Working capital items. So we have two current assets. Accounts receivable went down, so we have a decrease. In accounts receivable. $3,500. So a decrease in a current asset, inverse relationship, increases cash. And then we had an increase in inventory. $7,800. And then we have three current liabilities in that list. We have accounts payable, which went down, a decrease in accounts payable. direct relationship. So a decrease reduces cash. We had a decrease in salaries payable. $1,400. And we had an increase in income taxes payable. $2,700. So we are not paying our taxes. So if you don't pay your bills, your cash will go up. Not sustainable. Don't try that. But you can increase your bank account by just stop paying your bills. Very short-term solution. If you add all this up, starting with the 68,400, all of this stuff, all of these adjustments equal 1,600 positive. Add that to the 4,600. Add all that up and you get 73,000. Is net cash provided by operating activities. So does that big long column of numbers, for those of you with computers, add up to 4,600? Yeah, okay. I got it correct. That's because we fixed this one. If that was 1,400, it wouldn't. It would drive us crazy. All right, so that's the difference between the direct and the indirect method. So the last problem I want to do today is problem number 6, which is a big, long, lengthy one on page 65. And this one is a more traditional presentation. It gives us the account balances from an adjusted trial balance. So it gives us all of the debits and all of the credits. So all of the debits are primarily asset accounts, but it's also some contra liability accounts. And it gives us all of the credits. And then it gives us a summarized income statement, multi-step income statement, with the various items pulled from there that we're going to need, as well as items B through J, which is the additional information that you're going to need in order to be able to do now all 3 sections of the statement of cash flows. All right? So let's, and I'm going to erase all of this so I can start it right up here at the edge because it's going to take up the entire board to get all that on there. Okay, so we're doing problem number 6. And I'll squeeze this in as best I can. I think it'll fit. We'll make it fit.
And you said the first 2 were indirect, right?
Yeah, this has all been indirect. And even this one is going to be using the indirect. And the only difference is between what you see now and what you'll see on Tuesday is that the indirect starts with net income and then makes a series of 2 types of adjustments. One for non-cash, non-operating items, and then the other one for working capital items. Whereas the direct method has cash inflows and cash outflows. And so cash inflows are like cash payments from customers. And we have to calculate that, which we can do with the income statement and the balance sheet. We can calculate that. In reality, you would have a cash receipts journal. And at the end of the year, you would go read the number off of that, and that would go cash. But they don't give us that. They always give us a balance sheet and an income statement. We have to calculate how much of it is cash. Which, think through it. It's very logical. What's the only difference between all of the sales you made and the actual ones that you've received in cash? Well, it's the increase or decrease in accounts receivable. So it's a very doable calculation, which you'll see on Tuesday. But right now we're going to do indirect. So indirect method, we start with operating activities. Net income. And in this case, it was 4,800. To that, we make a series of adjustments. For non-cash, non-operating, items. In the little summarized income statement here, we see the third line down is depreciation expense. $2,100. Three lines below that, we have a line on the income statement that says bond interest expense, $400. I'm sorry, $410. All right? If you go down to the other items, you will see in item H that a 12% bond was issued on August 31st, 2013 at 97. So, and if you look at the bonds payable, it went from a zero balance at the beginning of the year on January 1, 2013 to a $10,000 balance. So we issued a $10,000 face value bond at 97, which is $9,700 worth of proceeds, or a $300 discount. All right? So if this is a 12% bond, it's going to pay $1,200 in cash interest per year. Everybody with me so far? You issued it on August the 31st. So how many months was that outstanding for 2013? September, October, November, and December. 4 months.
Where do you get that 97?
It tells us in the problem. The selling price of the bond, it was sold at a discount at a price of 97.
H?
Yes. All right? 4 months is how much of a year? 1/3 is 400 in cash, which means the amortization of bond discount $10. That's the easier way of figuring that out. The other way is that you had a $300 discount. This was issued in August 2013. It's going to mature in 10 years. Okay? So if it's going to mature in 10 years, using straight line amortization, you're going to amortize $30 a year of this $300 discount. 1/3 of that is for 2013, $10. You can approach it either way. All right? Does that make sense to everyone? So, we have an amortization. Then we have both a gain on sale of investments and a loss on sale of equipment. So the loss is going to be an add back. That was 200. And then the gain on sale of investments was a deduct. And then the very last item as far as non-cash, non-operating is if you look down through our credit balances here, you'll see that we have a deferred taxes payable. And deferred taxes payable went from $800 at the beginning of the year to $1,196 at the end of the year. So it went up $396. So if deferred taxes payable went up, an increase, it has a direct relationship because it's a liability, increase in deferred taxes payable. That's it for the non-cash, non-operating. We then have our adjustments for for cash flow, effects from working capital. So, just starting with the working capital, accounts receivable went down. It went from 2,800 to 2,690, a decrease. In accounts receivable. $110. Inverse relationship for current assets. Accounts receivable went down. That means your customers were paying you. Inventories went from 500 to went from 8,100 down to 7,910. They went down, decrease. In inventories. $190. Prepaid items, $1,300 up to 1710, an increase. Of $410, decreasing cash. That's it for the debit side, because that's all the current assets. Current liabilities, accounts payable, went up, an increase from $3,800 to $4,150. So an increase in accounts payable. $350. Wages payable went from $1,100 down to $650, a decrease. In wages. $450. Income taxes payable went from $2,400 to $2,504. They went up, an increase. And then lastly, interest payable also increased. By $400. Add all that up, and you get $2,300 positive, giving you $7,100 as net cash by operating activities. We then have investing activities. And I'm going to start them here. I'm going to put just 2 lines of them here, and then I'll continue that section on the right side of the board. Investing activities are the rest of the asset side of the balance sheet. As I mentioned earlier, we're going to use every account on the balance sheet plus items out of the income statement. So operating activities are current assets, current liabilities, working capital. The rest of the asset side of the balance sheet, purchases of or sales of property, plant, and equipment, purchases of or sales of marketable securities and other investments, intangible assets, natural resources, okay? So we have marketable securities that went from $1,700 up to $3,000, but they also had that's it. They went from $1,700 up to $3,000. So we had a payment well, we had a purchase. Of short-term marketable securities. And I'll abbreviate that, marketable securities. And so that's a negative 1,300. Item number D says that long-term non-marketable investments that cost $1,600 were sold for $2,300. And that was this gain of $700 on sale of investments. So that's a plus. Proceeds from sale of long-term investments. $2,300. And then item F, equipment that originally cost $2,000 with a book value of $300 was sold for $100. And that's that loss up here, loss on sale of equipment. And if you look at our equipment balance, the equipment balance, well, it's got two things going on here. So you got to use information because we bought some new equipment also. So which we'll talk about here. So we have proceeds from sale of equipment. We'll put that right about here. And it tells you that we sold that for $100. If the problem didn't tell you how much you sold it for, it just told you what the gain was on the income statement of $200 and what the book value was, if they gave you the original cost plus the accumulated depreciation, you could figure out the cash proceeds, right? If it has a book value of $300 and we had a gain of we had a loss of $200, must have sold it for $100, okay? So they don't have to spoon feed you this information. You can figure that out. And then lastly here, we have a payment, well, second to last. Purchase of equipment. $1,600. 16,200. 16,200.